Portfolio stress testing before the next stock market crash. And if you're having a portfolio number one or a portfolio two, and what different investments are in these portfolios that might make a difference. And again, this is example only, education only, not financial, tax, or legal advice. So, as a fiduciary wealth advisor and tax planner, there's many softwares I utilize to help me aid and helping my clients find the greatest financial freedom for themselves. In this particular situation, a software has this awesome tool that allows me to choose different periods throughout time, like stagflation era, the dot-com bubble, or in this case, the global financial crisis. And I can take portfolios to see how they would do before, during, and after, and I can compare and contrast portfolios as well. Now, keep in mind here that the global financial crisis from 2007 to 2009, stocks went down about 50%. So we will be reviewing two different portfolios that we have constructed on here, and I'll go over those investments on how they would each perform if they started right before the crash, and then how those portfolios would look after the crash. That way, when you choose to have your financial freedom, when you choose to retire, you can know what's going to happen. So we go to these graphs here on the next page. Now we have one portfolio that has your typical stocks, ETFs, mutual funds, and bonds in there. Then we have another portfolio that has stocks, ETFs, mutual funds, bonds, but it also has fixed indexed annuities on here that provide guaranteed protections, guaranteed principal protections, and they still provide potential growth as well. And that's a mix. So when we look at these two portfolios on here, and there's that green and blue line you can see on the top and bottom chart, our big concern is how much incomes or cash flows could these portfolios pull out before the crash, during the crash, and after the crash. So when I look at these on here, again, I show clients that I'm working with on here is, hey, if you have a portfolio that has no annuities whatsoever, there's no guarantees involved on there. As opposed to if you have a portfolio that has some annuities in there, in addition to stocks, bonds, and mutual funds, here's how that could perform here as well. And so just my job here as a fiduciary advisor to show people the mathematical information, to show them the graph information. But the one thing that's hard to show people on here also is it's peace of mind. No one knows the future for sure. And so I always ask people, hey, if you're trying to get the most money possible, then of course, not having an annuity is going to be better for you. However, that also has the most risk possible. So I always tell people if financial peace, financial mindfulness, just peace of mind in general, and no concerns, worries, and fears is important to you throughout retirement, and at the very least, you should have a portion of your money invested or put into a fixed indexed annuity of a certain type. Then in addition, have some stocks, ETFs, mutual funds, bonds as well. That way you can enjoy your financial freedom and your financial future as way you want to do it without worrying every day about your entire portfolio crashing, because you know at least a portion of it has some guarantees there involved. As always, ask questions.